Welcome to today's Explainer. We are putting on our financial detective hats to dive into a truly fascinating case study of a major Malaysian stock. We're going to see exactly how a massive company operates right at the intersection of high finance and incredibly strict ethical guidelines.
So here's the dilemma so many investors face. Can you actually balance strict ethical rules with serious financial returns? Because we're talking about a 6.78% dividend yield and a strong buy analyst rating here. I know, it sounds almost too good to be true, right? Usually, applying strict investment screens, you kind of have to sacrifice some performance. Well, today, we're looking at a prime suspect that completely defies that expectation, Leong Industries.
Here's our quick roadmap for today. We'll start with what Sharia-compliant investing actually is, move into the Leong Industries profile, analyze their financial health, evaluate their macroeconomic resilience and risks, and finally, deliver our final investment verdict. Basically, we're going to dissect the rules of the game, the anatomy of this company, and its resilience for the future.
All right, let's dive right in. Section 1. What is Sharia-compliant investing? The rules of the game.
Before we can examine the company itself, we really need to understand the playing field. Sharia-compliant investing is a framework of ethical investing guided by Islamic principles. It strictly avoids interest, which is called riba, uncertainty, known as gharar, and gambling, or maisir. Now, in Malaysia, this isn't just a suggestion, it's rigorously enforced. You don't just guess if a stock fits these rules. The Securities Commission Malaysia, fully supported by Bank Negara Malaysia, actively screens these companies to make sure they hit these exact ethical benchmarks. It's a highly structured system designed to guarantee total compliance. Moving right along, let's get into Section 2, the Leong Industries profile. Meet the heavyweight, HLI.
So who exactly is Leong Industries Berhad, ticker symbol HLIND? Well, they are an absolute giant on the main market of Bursa Malaysia, but they definitely didn't start out that way. They were actually incorporated back in 1961 under the rather humble name Fancy Tile Works. By 1970, they commenced their public listing. Fast forward to today, and now backed by the massive Leong Group, they've reached a staggering milestone. They have rolled out 6 million motorcycles since their inception. Talk about an incredible evolution for a single company.
HLI's core business is essentially split into two distinct, incredibly profitable halves. It's like a two-engine machine. On one side, you have consumer products, driven by Leong Yamaha Motor, constantly churning out motorcycles, scooters, and parts. On the other side, you've got building materials, anchored by Quatra Holdings, manufacturing premium ceramic tiles. Both of these are physical, tangible manufacturing businesses, which perfectly aligns with Sharia compliance. There's absolutely no hidden financial maneuvering going on here. Just making and selling quality, physical products that people use every single day.
Time for a quick health checkup. Section 3. Analyzing the financial health. The financial report card. Let's look under the hood at their FY 2026 financial metrics, starting with a massive standout figure, 28.26%. That is HLI's return on equity. Sitting well above the industry average, this tells us that their corporate metabolism is running insanely hot. Management is exceptionally efficient at taking shareholders' funds and converting them into tangible profit. They are firing on all cylinders.
And we can see exactly how that efficiency translates straight to the bottom line. Earnings per share took a huge jump from 116.07 cents in FY 2025 all the way up to 135.30 cents in FY 2026. This correlates directly to a massive surge in attributable profit, leaping from roughly 368 million ringgit up to over 430 million ringgit. So they aren't just coasting here, they are aggressively growing their earnings capacity.
But hey, the crucial point is, what does this actually mean for you, the investor? Well, it means you get a very nice piece of the pie. LHI boasts a super attractive dividend yield of 6.78%. With a 1 ringgit dividend per share, this yield significantly outperforms most low-risk savings accounts and fixed deposits. For income-oriented investors looking for stable cash flow, this is a highly compelling figure that absolutely demands attention.
I know what you're thinking. High returns usually mean high risk, right? Well, actually, not necessarily here. Their debt-to-equity ratio sits at a remarkably low 0.057 times. This tells us their balance sheet is lean, resilient, and operating at a very, very low financial risk profile. They have minimal dependency on external borrowing. In an era where interest rates fluctuate wildly and debt is expensive, HLI is practically running on cash.
All of these incredibly strong fundamentals are perfectly reflected in the stock's technical chart behavior. HLI is showing a long-term bullish trend, consistently hitting higher highs and higher lows. At a current price of around RM 19.10, this strong upward momentum totally validates investor confidence for long-term capital gains. Honestly, it's no wonder the analyst consensus on this stock is a definitive strong buy.
But what happens when the external pressures hit? Let's look at Section 4, Macroeconomic Resilience and Risks. Weathering the macro storm.
Look, no investment exists in a vacuum, and every single company faces risks. For geopolitics and tariffs, HLI relies on localized production and diversified sourcing. But regarding inflation, this is genuinely fascinating. While inflation squeezes profit margins almost everywhere else, HLI leverages the gig economy to stay totally afloat. Think about it. Food delivery drivers and couriers rely heavily on Yamaha motorcycles as essential income-generating assets. This ensures steady demand for HLI's products even when consumer prices are rising. Finally, regarding foreign exchange volatility, they use non-speculative hedging. And ironically, a stronger Malaysian ringgit actually lowers their costs for imported completely knocked down or CKD parts. It's like they have a shield for almost every sword.
We've examined the rules, the profile, the financials, and the risks. We're at the end of our explainer, so it's time to weigh the evidence. Section 5, the final investment verdict. Putting it all together.
Let's concisely summarize the evidence from today's case study. HLI is highly profitable with that massive 28.26% ROE. It pays out a very strong dividend yield of 6.78%. It maintains a super lean debt-to-equity ratio of 0.057. And, as we just saw, it effectively mitigates big macroeconomic supply chain and FX risks. Ultimately, this represents a high-quality, stable, Sharia-compliant equity that is practically custom-built for long-term investors seeking both sustainable income and capital growth. It proves, beyond a shadow of a doubt, that you don't have to sacrifice performance for ethics.
Which brings us to our final question for you today. In a world of constant economic uncertainty, is your portfolio resilient enough to weather the storm? Have you considered how strict ethical screening might actually help you uncover some of the most fundamentally sound, low-debt businesses in the entire market? Take a hard look at your own investment strategies and see if they measure up to the sheer resilience of a company like HLI. Thank you so much for joining me on this explainer. I hope you found it as fascinating as I did. Keep learning, and we'll catch you next time.